Brandon Fletcher, Senior Retail Analyst at Bernstein. And let me ask you this. Great numbers for Target.
Yeah.
E-commerce, 31% growth. We saw with Walmart, it was like 41%.
Yeah.
But Target's actually saying it's that same day situation where you order it online, but then you pick up. That is not only helping them grow e-commerce, but helping them save a great deal of money. How does that work?
Yeah, so one of the things we forget about is that most of the items in retail are already in a store somewhere. So as impressive as it is for Amazon to have 300 million items, 95% of the sales occur in less than 5% of the items. So most of the items people care about are actually in a store nearby. Target's challenge has been trying to figure out how to pick those items and get your order together relatively efficiently. And that's what they've been improving quite dramatically, frankly better than we thought they could. There are also upstream improvements in the supply chain, and when we get those right, we think it'll be really exciting for them going forward.
So contrast that with Walmart. Walmart, which has also been executing well on its digital strategy, but it seems to be maybe spending more on a relative basis. So what is Target perhaps getting right that Walmart hasn't quite gotten yet? Or is that even the case?
Yeah, they're similar business ideas. The biggest difference is that when you are at a Walmart shopper, and Walmart baskets tend to be heavier with grocery, so that has lower margin. Target baskets tend to be heavier with softlines items and apparel, et cetera. They had a 10% comp in apparel while everybody else is dying. Target is the last department store standing. And when they gain that share, the mix of that product is higher. Plus, I can go and run and pick one blouse, and I have a $10 margin on that, as opposed to picking out grapes for you, which you will be very unhappy about my choices, and it will be extraordinarily difficult for me labor-wise.
Is there any reason to question sort of these retailers doubling down on e-commerce, just because we don't really know if it's profitable? And it seems like the only reason that these retailers are doing that is to just chase Amazon.
Yeah, there's definitely a question on profitability for these, but the way I'll frame it is this. If you walking around a store took, let's call it 40 minutes to accomplish a trip, if I can have someone with more technology on their wrist, handheld, Google Glasses or its equivalent, that allow you to navigate around the store, maybe I can get that time down to 20 minutes or 15 minutes. Or if I put things in the back room, I get it down to 10 minutes. And now I can have incremental profit. And that's what everybody's working on. By the way, it doesn't have to be a store. Walmart's building something that's a standalone pickup that's not a store. It's much faster to pick.
Brandon, I want to shift it to what we saw with Home Depot and, of course, with Lowe's. Not what the street was necessarily expanding. So what do we interpret from this?
Yeah, so Home Depot down, Lowe's up. It's not the normal way. It definitely usually goes the other way. That has been our call. And the reason we believe that's been so important is that the way Home Depot has accomplished its success in the past was harvesting cost and becoming an efficient and brilliant retail operations team. Lowe's was almost the opposite. If you wanted to know how to do retail, you would do the opposite of what Lowe's did about 10 years ago. And now they're getting so much better with an entirely new management team.
What am I missing in these Lowe's numbers? Because I look at it, it looks like a push. It looks like inline numbers. They actually missed on comps. Pretty big.
Yeah,
a pretty big miss on comps. Yet the stock is having a pretty good day today.
Yeah. So the key is the following: there was an impairment in their gross margin, and if gross margin was impaired in Q1, then you believe that there's never going to be earnings flow through on any version of comps. But now that they fixed those problems by getting better price optimization, suddenly you can believe that even a 2 or 3 comp will be enough to have flow through in earnings, and that's enough. They're trading at a 3-turn discount, almost 4, I think, to Home Depot prior to the print.
They actually tout that they're actually picking up market share on the pro side. Is that actually happening? Because that was big knock on the stock for a long time.
It is, and the reason is that Lowe's is more suburban than Home Depot, and there are suburban trades that are underserved. So, for example, one of the most fragmented businesses in America is lawn care. So who's the pro for lawn care? It's not Home Depot. It should be Lowe's. Currently, it's random mom and pops we don't even know the name of. And so that's where there's extra share that they can take. And we also think that Lowe's has another tailwind, which is we do believe millennials will eventually tire of godforsaken cities and move themselves back out to the suburbs. I'm biased to being from Texas. But when we think that shift happens, Lowe's, we think, will outcomp Home Depot more systemically because we think people will buy suburban homes. When your fancy condo in Brooklyn comes down 20%, you still can't afford it. But a very nice home outside in the suburbs will suddenly be reasonable.
Well, let me tell you, having cut many a front lawn, I'll take the sidewalks and the penthouse view. Thank you very much. Brandon Fletcher of Bernstein, good to have you here.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.